Don't look now, but inflation could be back in Japan. The country's consumers have grown used to falling prices after a decade and a half of almost constant deflation. Now they're starting to see the cost of everyday items creep up. In January, the consumer price index rose 0.1%. Regular wages were up 0.3%, the fastest rate of growth in almost 4 years. Japan's inflation-linked bond market has also begun to indicate modest price rises, for the first time since the Lehman crisis.
Finally, the Bank of Japan has embraced what it calls an inflation goal and says it will keep monetary policy very easy until it has achieved it. That may not sound very ambitious, but bear in mind that CPI has rarely nudged above zero since 1995.
Some people argue that BOJ has changed its policy stance completely in the wake of introduction of the price stability goal. But I don't think that the actual monetary policy making will change meaningfully. The government does not have a clear idea about how to revitalize the economy. The burden to stimulate the economy tends to be on Bank of Japan. That's a historical experience, and this will continue.
The BOJ's action has already helped to drive down the yen. That lower currency should help to import a little inflation, while improving companies' profits. The Nikkei 225, Japan's equity benchmark, is one of the world's best performing indices this year, up 18%. Corporate savings are turning negative, implying a virtuous circle of expansion. New investment, new employees, new companies coming to market.
Recently, stock prices have risen dramatically, sharply, and many international investors have probably been reminded of investing in Japanese companies. In addition to that, the continued weakening of the yen against the dollar is leading to a rapid rise in profit at many Japanese companies. So we expect more and more new listings of domestic companies.
The big challenge, though, is in overcoming expectations of deflation. Prices have been stagnant or falling so long in Japan that it can seem like the natural order of things. As Japan's economy has struggled to compete with Asian neighbours in recent years, companies have tended to keep salaries flat rather than cut jobs. As a result, the official unemployment rate in Japan has not risen anything like as high as in the US or in Europe. That's good for social cohesion. But if pay packets don't rise, inflation expectations don't take root. Real interest rates have also been so high for so long that companies and households are reluctant to borrow to invest. Outstanding bank loans have flatlined for 2 years and are down by more than a quarter since the peak in 1996. And crucially, the fact is that mildly falling prices are no bad thing for large segments of the population.
Bank of Japan Governor Masaaki Shirakawa often likens the relationship between economic activity and prices to that between a body and its temperature. To raise that temperature to a normal level, he says, you first have to improve the body's fundamental strength. But for a generation that's seen real economic growth rates more than halve between the 80s and 90s, and then halve again in the 2000s, that will take some doing. The spirit may be willing, but the flesh looks weak. Ben McClanahan, Financial Times, in Tokyo.